Welcome to the Wealth Matters podcast, where investors come together to better understand how to build passive cash flow and create generational wealth without all the confusing mumbo-jumbo. Here's your host and co-author of Amazon #1 bestseller, Alpesh Parmar.
Welcome to Wealth Matters podcast. I want to talk about something different today. Mostly the last 3-4 Monday episodes have been on cryptocurrencies and or Bitcoin. Actually, our fund, Terracell Fund 2, has officially closed. We are fully subscribed. So I want to talk about something else other than Bitcoin and crypto. And actually, next week, I'm planning to talk about cryptos again and speak about how you can stake your coins to make more money as well. If you want to check out my last episode on how to earn interest on your cryptos, feel free to check that out as well. So today I want to talk about how to analyze an investment and mostly focus on real estate investment. A couple of friends have reached out and they want to invest in real estate. And of course, I asked them to check out the podcast, but we are over 150 episodes now. They'll have to go through a ton of episodes. So I wanted to condense what I know or what I look for in an investment in this episode in the next 10 minutes or so. So the most important rule of investing in real estate, either yourself, which is active, or passively with someone else or as a partner in a syndication, is look at the most important thing: location, 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 right? I think those are the top three most important things in a real estate investment. Do not forget about location. You have to make sure that the location has, now that, over years, my criteria have changed. So this is my personal criteria. Of course, feel free to slice and dice and create your own criteria. It's very important to figure out your own investment criteria, especially in real estate or any other investment. But here, from the location has to pass my taste of that MSA has to have, or metro statistical area has to have at least 100,000 of population, right? That's very important. Second, that has to have job growth, right? And the third is that there should have be inbound migration. I don't want to see a negative migration or outbound migration. So those three, again, location, 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 and you can put these three at the top of your list when you are identifying or trying to look at a location, right? That's pretty much important. The second criteria you would want to look at is, what do you want to get out of this investment? I have seen people, they prefer appreciation. They invest in San Francisco Bay Area, Austin market, Raleigh, wherever, or Seattle, Washington, wherever they can find crazy appreciation, right? That's one. That's like investing in stock market pretty much, that you don't get paid till you sell or dispose of that asset. Some people like me are focused on cash flow. So of course, most of the MSA or large MSA, I cannot invest, be it Dallas, Austin, Raleigh, Charlotte, San Francisco Bay Area, Seattle, Orlando. And now, of course, I love Atlanta, but even now Atlanta, because the prices have gone up so much that you will barely have a cash flow. And I don't want to see personally a negative cash flow or even break even. I want to see a positive cash flow. So that's my criteria. Some people prefer appreciation, some people cash flow, and some people prefer hybrid, right? And that's actually what I prefer. I want to see good amount of cash flow. I would say 6 to 8% annualized return. It used to be up about 10%. Of course, the prices have gone up everywhere in US. So 6 to 8% annualized return, while my property is also appreciating in a nice neighborhood, nice MSA. So that's what I look for, hybrid approach, but cash flow takes precedence over the appreciation game, right? So cash flow is the most important, and then the appreciation. So figure that out, the second part, and then as soon as you look at a deal, try to align it with your investment criteria and see, does this deal fit into your criteria, right? Location, second, if it can give you appreciation and cash flow, or either of those, etc., etc. The third is figure out the kind of neighborhoods and the property types you want to invest in. So the neighborhoods go from A class, B class, C class, D class as well. And anything, I think most of the people will say anything below C is almost pretty bad. And I would not personally invest, but it may work for some people. So look into that. The property class would also be, what is the condition of the property, right? Maybe the area is A class, but the property is C class. Now that means you have a pretty large room to play with, right? You can make that upgrade that property. Maybe you can raise the rent. If you sell it, of course, the value has gone up because you upgraded the property, right? And sometimes you'll find A class property in C class neighborhood, and I'm like, that's usually not gonna make much sense unless that neighborhood is going through gentrification. Or it's in the path of progress, right? So figure that out as well in your criteria. I mostly look at, and that's again my personal criteria, that I want to look at B to C class properties in B to C class neighborhood, right? But most of the time I want to take a C minus property in a C minus neighborhood, because that's like, worst of both scenarios, worst case of, both the property type and the neighborhood type. So figure that out. A lot of time, if it's an A class property or A class neighborhood, I am almost positive that you will barely break even, or most probably not even break even, right? So that's why I don't look at it. But those are more stable type of assets. If that's what you crave for, if that's what you think will make sense in your investment criteria, then go for it. I look at B2C class, as I said, B2C class properties in B2C class neighborhood. And then another thing you want to figure out now, the next is that what is the rent to price ratio you are willing to pay, right? What makes sense? Because a lot of time when you figure that out, your A-class properties or A-class neighborhood would be gone from your, or they won't show up, or they will get filtered out from your deal analysis tool itself. So first, analyze the location. The second, if you want, if once you know this is the return you are looking for, look at the rent to price ratio, and you'll be able to weed out most of the deals. That way, you are not wasting your time on the deals which are not worth your time effort, right? So for me, I look at it used to be 1% to 1.2% rent to price ratio, because I started looking at 1.5 to 2% price to rent ratio, and I lost a lot of money by doing that, because I ended up buying properties in a D class neighborhood, a D class property. So now I only look at investments which are between actually 0.7 to 1% price to rent ratio. It's very hard to find anything over 1%. If you can, well and good. But 1% is the gold standard. A lot of people talk about it. My criteria used to be 1 to 1.2. As the prices have gone up, now it's between 0.7 to 1.1%. And what that means is, if you buy $100,000 property, the rent should be around between $700 a month to $1,000 a month. So these are some of the criteria I have put into place. So this is how you should start analyzing the property. And of course, the more deals you will analyze, you'll learn more about it, right? You'll get better at analyzing investment properties. So please reach out to me. Let me know what you think of this episode, and looking forward to hear back from everyone. Please like and subscribe to this podcast episode. If you are watching this on YouTube, please subscribe, like, and share with your friends. Thank you so much for watching. Have a great day, everyone.
Thanks for listening to the Wealth Matters podcast. If you enjoyed it, please leave us a 5-star rating on iTunes so others can enjoy the show too. Have a great week and happy investing!